and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We got 1 hour to go until the market closes. So let's take a look at what's going on with the major averages. We had a very, very sharp sell-off today, which is now a little bit less of a sell-off today. So it's been an interesting situation today. Obviously, the implementation of tariffs at midnight, they were effective on Mexico and Canada for 25%, on China at 20% total now. And so we see initially a lot of selling in the market. Oh, they actually happen. It's not just sort of back and forth negotiating. The Dow down 230 points, 0.5%. The S&P 500, though, only now down about 0.1%. And the Nasdaq's up 0.75%. Go figure.
Yeah, I was assured, Julie Hyman, that tariffs were a negotiating ploy. It was a negotiating tactic. I had very smart people telling me.
It might still be.
Perhaps, but they seem here now, and we see this, as you're pointing out, it's causing uncertainty. It's causing volatility. Investors are trying to figure out, what does this mean for the economy? What does it mean for earnings growth? But a problem, I think you're sort of suggesting it right there, is in terms of answering that, is you have very basic questions that remain about how long are these tariffs actually even in place?
Right.
So it gets very tricky to try to think through all these domino effects.
It does. And then, of course, there is another round that's scheduled to go into effect in April. So there's that to consider. But now, when you look at the Nasdaq, you have to consider, are we now seeing the momentum unwind? In other words, where we have seen many of those big cap tech momentum names come down over the past couple of weeks, now are we seeing people say, okay, they've fallen enough.
Look at NVIDIA.
Now we want to get back in here.
One of those names we talked so much about, which has been so banged up, solidly in the green in today's
Exactly.
trade.
So that's one of the best performers. Looking elsewhere today, just a couple of other things to mention here. First of all, we've got the 10-year, which is coming back up a little bit, part of the overall reversal we're seeing, but coming back up from a very low level, 4.21%. And we are seeing, interestingly, some weakening in the U.S. dollar index, right, overall. And we've got the Canadian dollar kind of volatile against the U.S. dollar today as people, again, try to just figure out what all of this
How much
means.
of this, in your opinion, is just uncertainty, too, about basics of like what we're even trying to accomplish? I mean, you do have Trump surrogates out there making the case. I personally am still waiting for the good case to be made about what exactly we're trying to accomplish. Or, for example, Canada. Now, I know Trump tonight adjusting that joint session of Congress. Maybe that becomes more clear.
Maybe he just doesn't like Justin Trudeau, who is not going to be likely in office after Sunday.
This is true.
Who the heck knows? But Jared Blickery's got a broader look at what we do know, which is what's happening in the markets. What are the numbers saying?
Yes, let's take a look at volatility really quickly here because I think that's instructive. I'm going to show you a 3-month chart of the VIX. The higher that is, the more uncertainty we have. So pretty apropos here. This big spike here, that was mid-December. That was a Fed meeting. So we are not quite at those levels just yet. But that is stock market volatility. I want to show you the ICE-BofA Move Index, which shows you volatility in the bond market. That is pretty high here. That surge there usually coincides with weakness in risk markets, especially equities, and that's exactly what we've seen over the last few days as we've seen volatility flag higher. And let's take a look at the sector action. I think it's very instructive. Look at tech there, looking very lonely, all by itself in the green, of 1%. Now, sometimes the Mag 7, sometimes those bigger names are part of a safety trade. So you could say, is this defensive here? Because everything else strongly in the red, financials leading to the downside. But you take a look here, there's actually quite a bit of green. Now, not all the big names are positive, and not all of them are positive by a large amount, but you do see some decent gains in Alphabet and NVIDIA, which Josh just mentioned, Broadcom, which could be the Mag 8. Now, you see Tesla. Tesla's negative here, but I want to show you what's going on inside the ARK Innovation Fund. If I sort by equal weight, you can see a lot more green than red. This is disruptive tech. This is unprofitable tech. So tech broadly is doing well. Here's the semiconductor space. Outside of Intel, which is down 4%, we're seeing a lot of green here. If we look in software, there's less green that I would say than we saw in semiconductors, but we're also seeing a pretty balanced picture here. So you put it all together, we're seeing a lot of negative action. We got a bounce in the S&P 500 off a key technical level. I'm going to get into that with Josh later in the show, and things could be a lot worse now. I think that's my bottom takeaway.
It looks that way from the market's perspective. Jared, thank you. As we've been talking about, markets have indeed recovered somewhat today after fears of a deepening trade war rattled Wall Street, with China and Canada announcing retaliatory measures against the United States. Canadian Prime Minister Justin Trudeau, for his part, made his feelings on the developments quite clear this morning.
So today, the United States launched a trade war against Canada, their closest partner and ally, their closest friend. At the same time, they're talking about working positively with Russia, appeasing Vladimir Putin, a lying, murderous dictator. Make that make sense.
Helping us to make it make sense, perhaps, is Libby Cantrill, PIMCO head of U.S. Public Policy. Or, Libby, does it have to make sense, right? It doesn't matter if it makes sense or not. It matters that it's happening, I guess, from a market perspective. And the market participants have to deal with it. But it's tough to deal with when you don't know what's going to happen next. What's your best guess at, for example, how long these particular tariffs that just got put in place, how long they last?
Yeah, Julie, well, that's exactly right. And this is what we've been talking to our investment committee, our traders about, is that, love this policy, hate this policy. That doesn't matter. What matters is, what President Trump's worldview is and how he wants to implement that. And what kind of broadly we've been telling both our traders and also our clients is that, to your earlier conversation, are tariffs going to be used as a means to an end, meaning to increase the U.S.'s negotiating leverage with other countries? Absolutely. But are they going to be used as an end to themselves, meaning President Trump does believe that tariffs help to reduce the trade deficit? They think the trade deficit is symptomatic of much broader issues. Absolutely, yes. So I think these are not mutually exclusive. They will be both used as a negotiating tactic, but again, also as a tool to decrease the trade deficit and sort of rebalance trade. Now, as it relates to these most recent measures, there are some off ramps, and I do think that the market will be keenly looking at them for these inflection points as a possible off ramp. The most recent one, or the earliest one, is going to be the steel and aluminum tariff date. That's on March 12th. Then April 1st is going to be a really important date. That's when a bunch of the investigations and sort of trade output from the America First trade policy is due, and that is potentially an opportunity for the president to swap these tariffs with maybe reciprocal tariffs that would be lower tariffs. I think that the last thing I'll say is that I think the biggest fear, though, for the market is that these are not temporary, that these do have longevity, and that they potentially last for the entire duration of the USMCA review. That statutory review is due July 2026, and that would obviously have some real implications for both growth and inflation should they be on for that long.
Libby, you would be hard-pressed to think of a faster way you could really quickly get on the wrong side of the electorate than if your policies raise prices and start banging up people's 401ks. I'm just curious, in your opinion, how cautiously does Trump need to tread here politically?
Yeah, and I do think that there is a political limit to this, potentially. Now, what you've seen from Republicans on Capitol Hill, both in the House and the Senate, so far in the last 12 hours or so, is that they're giving the president the benefit of the doubt. They're saying that maybe they're concerned, they have worries about the policy, but that they are supportive of this sort of America First approach. Now, I think the real question is some of the stakeholders, some of the constituencies that helped to get President Trump elected, how do they respond? Like the farmers, for instance, like some pockets of the unions, for instance. So I do think that is an open question here. I think the other question is how sensitive will he be to that pushback? I mean, this is obviously his second term. He is likely not running for re-election. Of course, the Constitution prevents him from doing so. And there is a view that there were a lot of things left undone in the first Trump administration as it relates to trade. So I do think that is going to be some pushback, Josh. I think that will be a real dynamic. But I think the question is how sensitive is he to that, because he doesn't necessarily have to be as sensitive to the political dynamics given he's not running for re-election.
Well, Libby, and one could make an argument that President Trump was elected in part because of the economy, because of inflation. And now Americans are going to go to the grocery store and their avocados are going to be potentially 25% more expensive. We'll see how that gets passed through. Their tequila is going to be more expensive. Their vehicles are going to be more expensive. As a result of all of this, even if it's temporary, right? Americans are tired of inflation at the same rate it's been. How is that going to filter through to the administration? And is that something that Trump will also be able to shrug off?
Yeah, as you just alluded to, I mean, it remains to be seen, right? I mean, I think that there is an argument that these tariffs get directly passed through. I believe that the CEO of Target sort of intimated that. I think there's also, maybe the thinking that the producers, the sellers will also eat some of the tariff. And then if you do have currency, adjustment, that might actually mitigate some of the inflationary impacts. But the bottom line is that voters partly did exactly what you said, partly did vote for President Trump because they were upset about the price of groceries, the price of a gallon of milk, the price of a carton of eggs and what have you. And should the direction of travel here be clear that the prices are just going up on foodstuffs, that is absolutely going to, alienate them. I think that there's a kind of a question within the Trump world about that thesis, about whether it actually does impact inflation. So in some ways, it may have to be kind of show, not tell, in order for them to actually believe it. But if that does come to pass, I think voters will react quite negatively.
Libby, switching gears here, another topic, a U.S. funding deadline does fast approach. How does that play out, Libby? I mean, do viewers listening right now, do they need to be ready for a shutdown?
Yeah, there's no shortage of policy activity in Washington, needless to say, that could impact markets. This is as you all know, the funding. There was a decision made in the fall just to extend funding for the fiscal year 2025 just to the mid-March, hoping that actually Congress might get its act together and pass what are called appropriation bills. They did not do that. That means that they have to pass basically a straight line funding bill until the end of September. I think the conventional wisdom is right about this, that there will not be a government shutdown. There were some threats that the Democrats may actually try to shut down the government. I think that is kind of a political loser, and they've kind of come around to that thinking as well. I would just say the only caveat, though, is that if it's not a straight line funding bill and Republicans insist on codifying some of these DOGE cuts, for instance, that will lead to a shutdown. So I think that is an open question, but it looks like all kind of arrows are pointing to the fact that it will be what's called a clean continuing resolution, a clean CR, and therefore will avoid a shutdown, hopefully.
And Libby, finally, quickly, of course, we've got the president speaking tonight to a joint session of Congress. From an investor's perspective, what do you think people should be keying in on or listening for in terms of getting more information?
Yeah, I think it's going to be a really important moment and in many ways for market participants. I think there will hopefully be some more clarity around exactly what you all were talking about before, which is what exactly does the president want from Canada and Mexico? This is being viewed as a non-trade issue, right? Fentanyl and immigration. So what can those countries actually do to assuage the president? I also think there will be, folks will be tuning in around Ukraine. Will this sort of pause in Ukraine funding, is that going to be more long lasting? Could we be potentially on the precipice of a deal with Russia? That's been rumored that maybe sanctions relief is coming. And then I think lastly, something that could be potentially impacting growth, particularly on the payrolls, is around sort of these DOGE terminations, DOGE-related terminations of the federal workforce. And does President Trump really lean into that? Or is he kind of getting a bit of cold feet? With something we just saw from the Office of Personnel Management was actually sort of a revision of a memorandum around probationary workers that actually now it's up to the agencies themselves and not sort of the DOGE effort. So that I think will all be important sort of signaling to the markets of, I always say, are they going to have vegetables or dessert? So what kind of combination we've had a lot of vegetables recently. I think the market wants some dessert.
We'll see if we get it, Libby. Thank you. Appreciate it.
Thanks. Appreciate it.
Well, as tariffs have officially gone into effect today, companies across the country began to warn of the impact. According to AlphaSense, the number of mentions of tariffs on earnings calls has skyrocketed this quarter, and they track, even if it's just one mention during a call, they count that as one. They don't count it as many times as you say it on a call. But obviously, it is much more a topic of discussion. And we were just discussing this with Libby Cantrill. Are companies going to pass it through to customers? Target Chief Executive Officer Brian Cornell telling reporters following results today that, quote, depending on the level of tariffs, we're going to have to take some level of action. Presumably that action would in part be raising prices. Another example, after after reporting an earnings beat this morning. Best Buy CEO Cory Barry, she warned as well about tariffs, saying that they expect to see an impact moving forward and that the vast majority of the product assortment that we have in some way, shape, or form right now is subject to some level of tariffs. She talked about that China and Mexico are the top two sources of imports of products for her company, and she said it's highly likely that there will be an increase in prices because of the increase in tariffs. Then there's AutoZone, the CFO there, Jameer Jackson, saying on the call that there are several tariff-related outcomes that could impact their goals. He said, to be clear, we intend to maintain our margin profile post-tariffs, and we expect the entire industry will behave in a rational way as our historical experience has shown. And that, again, implies some pass-through. In the home improvement sector, it goes on and on here. Masco CFO Richard Westenberg saying at a conference to, quote, expect that you'll see associated price increases appropriate and necessary to help mitigate the tariff implications. You get the picture. Many companies in different sectors in this country are bracing for these tariffs and are preparing potentially to raise prices as a result.
For more on the latest market moves, let's now welcome in Melissa Brown, SimCorp Managing Director, Investment Decision Research. Melissa, great to see you here on set.
Yes, great to be here.
So tariffs front and center, Melissa. I think there's a lot of viewers listening right now. They're just wondering, what does this mean for me, my money, my portfolio? Your thoughts on that?
Well, I think exactly what we've just been saying, that they're likely to drive inflation higher. They're likely to drive corporate profits lower, either through lower revenues or higher costs. So I think margins are likely to come down. And the question remains, is this just a negotiating tactic, or are these tariffs really going to take place? And I think if they do, it is going to have a major impact on inflation.
Well, and speaking of inflation, you had the Fed's, New York Fed's President John Williams speaking at an event today and talking about all of this. I'm just looking at some of the headlines here. He says you have to watch inflation expectations closely. He says he could expect a very high pass-through of tariffs to consumers. So if indeed we are going to see inflation at this level or even ticking up as a result of this, then what are the implications for the Fed?
Well, there's kind of two offsetting things going on, because the Atlanta Fed came out with their model saying that we're actually probably in a recession right now. And so I think that makes the Fed's job is always hard, and no doubt, but I think it makes it particularly hard because they have these two opposing forces that would drive two very different scenarios for them. Right now, markets are betting on that they're going to cut rates, that they're actually going to react to this this news, or at least speculation that we may be in a recession. And so we've seen the probability of a third rate cut this year go up.
Do you think, Melissa, when you saw the kind of moves in the markets, in your opinion, was that the market sending a message to Jay Powell and company, like you should be more concerned now about growth?
Well, I think the market is always sending, those messages. I think if you listen to what Jay Powell says, he stands back, he just looks at the data, and he's not going to look at what's happening one day in the market. But I think, the ugly word that we're not talking about is a potential for stagflation. So low growth and high inflation, which if you look at that data, it seems like that potential is there.
And then you also have a geopolitical environment that is somewhat destabilized right now. You look, of course, at what transpired this week between President Trump and President Zelensky of Ukraine. You look at the Mideast, et cetera, et cetera. Usually the market geopolitical stuff happens. Maybe there's a quick reaction and it shrugs it off. Can that still happen if you're looking at a potentially stagflationary backdrop, for example?
Well, I think you've got the stagflationary backdrop. You also have, it's not just the Middle East and Russia. It's, what the president is saying about Denmark and Panama and Canada. And so I think there's a wider geopolitical implication. It's not all war related, but there is this geopolitical backdrop that I think just makes this potential issue of stagflation worse.
Well, Melissa, Trump is going to address that joint session of Congress tonight. Just as a market pro, I'm curious, if you're watching that as a strategist, what are you listening for? What do you want to hear?
Well, I would expect that we'll hear something about the stock market. He does seem to be very focused on what the market. So the market may not be telling Jay Powell anything, but I think Trump is looking at it.
Oh, interesting you say that, Melissa, because that's always been, we've heard that from people, that Trump watches the market, he sees it as a report card, and hey, if he sees too much red for too long, maybe he reverses policies. Is that your bet?
I think that certainly is a good possibility that he believes in the market and may reverse policies if, as you say, if there's if he sees too much red. But as Libby just said before, there's also this, if he's not worried about re-election, if he's really dug in, then maybe not. Then maybe, as we always, the market does always eventually recover, and so maybe he's going to bet on that.
And the market did recover today, by the way, at least part of it, right? The NASDAQ did bounce today, and all three major averages are coming back from their lows. It seems like there's a rotation back into some of those large cap tech names. Is there the thinking both that maybe they fell too far and that these are sort of more quality areas of the market or safer areas of the market? Do you think that's what's going on?
Well, I think we have an issue with a market that's very concentrated in a few names. And so, yes, today maybe some of those names are looking better and investors think they've hit, near-term lows. But this problem of concentration in those names remains. And the more they go up, the more concentrated the market's going to get, which makes it very hard, first of all, to beat the market. And eventually, we've seen historically this level of very high concentration doesn't last.
Do you expect that to evolve at all, Melissa? Would you expect a broadening in 2025?
I think it depends on what happens with trade policy, with what's happening on the geopolitical front. It certainly is a possibility that we get rid of or we reduce this concentration by broadening. Typically in the past, it's really been more that the most concentrated names have come down.
And so what do you do as an investor then? How do you try to outperform the market or even just match the market in this environment?
Well, if you want to match the market, then you really need to be in these bigger names.
Right.
I think we're seeing investors, investor sentiment is somewhat negative. So investors are behaving more defensively, buying lower volatility names, lower beta names. So I think, that does seem to be a reasonable strategy now if you want to stay in the stock market. I would also say if you don't particularly need to stay in the stock market, bond yields are reasonably high. They're certainly, if you look back a few years, they're much higher than they were. And bonds could, potentially be a safer investment for many investors.
Interesting. Melissa, thank you so much. Good to see you in person. Thanks. We're just getting started here on Market Domination. Coming up, Tesla's latest shipment data out of China. Not great. Just the latest piece of bad news for the EV maker. Shares are now down over 30% year to date. We'll check in on that and some of the other top trending tickers on the other side. Stick around. Much more Market Domination still to come. Now time for some of today's trending tickers. Let's start with Tesla. The latest shipment data out of China, not good. Just the latest piece of bad news for the EV maker. Joining us now with more, Yahoo Finance's Subramanian. Now, we had seen sort of the numbers spreading across the globe showing that Tesla's sales have been going down. What did we learn today?
Yeah, new data out of China showed shipments are down by half compared to last year, and then also another half compared to January. So not really good there for Tesla. It's kind of indicating again demand issues for the company. China is a little bit different kind of territory. You have very high competition with EVs that are just as good, cheaper, have better tech because Tesla's struggling with getting their autopilot software there. So it's just another sort of warning flag here as we've seen sales in Europe tumbling, concern here in the United States with protests and people saying kind of a buyer strike we're hearing about. So we've seen a lot of negative headlines for Tesla. It seems to be happening in basically all their major regions right now. One little wrinkle is the fact that there was a Model Y changeover where they were changing over the factory for the new Model Y. There could have, maybe some buyers held back on buying a new Model Y, but at the very least, the headline numbers do not look good, and it's not just China, it's kind of everywhere.
Let me ask you, so that, I mean, not good for Tesla in China. I'm just curious, how's the home team doing in China, the domestic players?
Well, conversely, I believe sales were up 80% for new energy vehicles in that month, meaning hybrids and pure EVs. So it's not the market. The market's doing quite well, and even then it was during the kind of the spring lunar holiday season where typically sales are a little bit lower. They're showing sales are actually jumping. So this is not necessarily good news for Tesla, even with potentially the Model Y changeover.
Do we know if there is a political element at all? Has the Chinese government been encouraging people to not buy Tesla amidst this burgeoning trade war?
I don't think so. I don't think there's Elon Musk is perceived as so negatively as potentially here. But there was an FT report about how the Chinese government would use, say, let's say, FSD approval as a sort of a cudgel against Tesla and the U.S. for tariff sort of reciprocity. So there is some struggle there. The Chinese, they're aware of this and may try to play that to their advantage.
Interesting. All right, Ross, thank you. Appreciate it. Our next trending ticker, Scott, C Limited, because that stock getting a nice boost in today's trade. This is the e-commerce company jumping gross merchandise volume. It's going to climb about 20% at its online retail arm. That's Shopee. Bloomberg pointed out that suggests GMV of about 121 billion, Julie, which does beat estimates.
Yeah, and this is a company that, as you say, owns various e-commerce companies. One of them is called Shopee, which is not a big player, obviously, here in the United States. But the implications in this report is that perhaps it's doing well against competitors like Lazada. Temu would be another sort of potential competitor there from the company. Fourth quarter revenue was up 41% at Shopee specifically to $3.7 billion. And Shopee's actually been raising its commission fees, and it seems to have been raising them successfully. The stock, by the way, has been ripping. The U.S. traded shares more than doubling over the past year.
145% over the past 12 months. Have you missed your shot? Is it over? Not according to analysts. I mean, they love this one. Overwhelmingly bullish on the street.
Interesting. All right. And our next trending ticker is Illumina, the medical diagnostics company, one of the first to face immediate and direct backlash in the escalating tariff war between the U.S. and China. Yahoo Finance Anjali Kamlani is with us now. So basically, they can't sell their gene sequencing equipment in China right now, right?
Right, which helps with research and development of drugs as well. So this is an important one because we're not sure if it's completely the China tariffs, but it is getting that impact. It also could link to the Biosecures Act, which prevented U.S. companies from working with China, essentially, especially if they get any kind of federal funding for development and research. Now, what we're looking at with Illumina is one of the first of potentially several more. China already a headwind for some major companies, including medical device companies and drug companies for the year, with changes in how China has been doing business with healthcare companies. So this is just another pain point for the U.S., but definitely looking at Illumina accounting for 7% of sales in China. Other companies somewhere between 5 and 15%, according to Bank of America. So this is concerning, and Bank of America analysts have noted that they're going to continue to watch and see how this escalation really impacts some of these medical device companies. We know, for example, Philips, for the longest time, a really major player in China, also exposed to some headwinds from the changes and China's economy overall. So this is basically just adding pain on top of what has already been a challenging environment for them in China.
It's worth noting, however, the stock is up now.
Yeah.
Right? We've seen this turnaround in the market. Illumina shares, despite this, are up a little more than 1% today, but they have fallen 36% year to date. So, because this was not a shock surprise out of the blue, China had already indicated it was moving in this direction, and so the shares have been pulling back.
They'd already blacklisted them once the tariffs first went into effect in February, and so now this is just an escalation of that.
Gotcha.
All right, thank you, Anj. Coming up, shares of JetBlue, they are lower today on the back of a bearish analyst note. We're going to check in on some of the top calls of the day when market domination continues.
Escalating trade tensions taking a toll on the broader market. They're coming amid a mixed economic backdrop around the world. Our next guest has insight from the front line. He runs the North American division of Saint-Gobain. It's a French construction materials company. Joining us now, Saint-Gobain North America CEO Mark Rayfield. Mark, thanks for coming in.
Thanks for having me.
Appreciate it. Or Saint-Gobain, I guess, as you say it here.
Exactly.
Stateside. Obviously, we've been talking all about tariffs today, so I have to start there because when I think of construction materials, I think in some cases of stuff that has to come in.
Right.
But I understand a lot of what you all manufacture is made in the United States. Talk to me about the mix here and how you're managing.
So you think construction products, you think a lot of lumber, which is a big topic that happens. For us, we make roofing materials, drywall materials, siding, and insulation. They're local products made in the U.S. for the U.S. market and made in Canada for the Canadian market. So if you were to see a roofing truck go by you loaded with shingles, it would look half empty because it's very heavy. So they don't ship very far, and gypsum doesn't ship very far. So our plants are local to the markets. We're building a plant in the Southeast to cover the Southeast market. So tariffs are clearly an issue because you do have some cross-border trade, of course, in this process, but it's nowhere near as much as other industries that are making products go back and forth.
And has it always been that way, Mark, or no? Was that shifting, evolving over time?
It's always been that way. I mean, I think we've on a raw material side, we've onshored to North America a lot of raw materials that, if you go back 4 or 5 years ago, everyone left Asia and China and brought it onshore. So some of that is a North American supply, but still relatively small. But the customer base, because it's construction and heavy materials, has always been very local. It doesn't ship far. Your construction methods are different in Quebec than they are in Toronto, than they are in Florida. So your product mix goes a little bit differently. And with the acquisitions we've had in Canada, now we have all the product offering. We bought a siding company and a roofing company in Canada, so we have those products in Canada as well.
I am curious though, if because if you're thinking about a building or a house
Yes.
made up of all kinds of things, do you all have sort of less pricing power at a time like this? In other words, if the person or the company that's building the
Yes.
thing comes to you and say, I can't pay more for roofing. I'm getting killed on lumber over here.
Yeah.
Is that how it works?
Well, I mean, I think it doesn't really, it works to some degree. The big builders will say we need to manage our costs with some perspective, but they are delinked. I mean, there is a risk that housing prices, which are already at a pretty high affordability aspect for people, will go higher with inflation on products because there are some imported building products and lumber. We don't correlate it to ours, so we aren't looking for a price decrease based on lumber going up.
Gotcha.
I'm curious, Mark, tariffs or, even just the threat of tariffs that can obviously impact business confidence, consumer confidence. What are you hearing from your customers?
I think, probably everything you're hearing on this show, our message remains control what you can control. Mm-hmm. And so there's a lot of news constantly coming out and a lot of change going forward. So we focus on what our distributors need, our contractors need, and we focus on operational excellence in our plants. The rest of it we can't impact. And so as tariffs come and become more visible, we may have to have, some pricing in places on certain markets or certain raw materials. But by and large, we try to kind of let it flow over.
And what is your read on the housing market? As you said, affordability is a problem right now.
Yep.
Interest rates aren't really coming down that substantially to affect mortgage rates.
Right.
So then how does that end up affecting demand?
So for new housing, it's at a decent rate. It's 1.2, 1.3 million homes, which we would have been happy with, 5 years ago, and still a pretty good rate. A lot of our business is renovation and remodel. If you think about the big housing boom, it was in the 2000s. Those homes are 25 years old. So they're getting renovated. You have a lot of weather impacted events which force renovation if it's hail or windstorms going forward. So that market's relatively resilient. So, and the final part is, which ebbs and flows, is you have roughly 5 million homes underbuilt in North America for the family creation that's taking place. My kids are in the 28, 30, 32 range. They're starting families now when I start them at like the 24, 25 range. So it's later, but they're all happening. And so you have that underlying fundamental demand. So it's certainly, bumpy during areas of uncertainty because individuals don't want to spend as much and they're nervous. But I think we've been in a period of uncertainty now almost since COVID, so people might be getting used to it.
I'm curious too, Mark, inflation still an issue, still higher than the Fed would like it to be.
Yes.
How are you dealing with that? What levers are you pulling there in terms of pricing, expenses?
So we've been able to manage inflation by managing very tightly our raw materials. We've been able to manage our cost of manufacturing, and we have been able to pass on what inflation we have hit. So we have kept a positive cost of factors, as we say. So we've been able to price above our inflationary level over the last 4 years.
Mark, thanks so much for joining us. Appreciate it.
Thanks for having me.
Thank you.
Thanks.
Thank you.
Take care. Okay, thank you very much.
Loop Capital downgrading DoubleVerify from buy to hold. That move is coming after what we know is a rough 2024 for the company. This one, Julie, let's see. Following a tough year, here's your note. In 2024, as a cohort of 6 large customers struggled through company-specific issues, a second year, they say, of disappointing outlook is a challenge to the investment thesis. Marginal outperformance versus lower expectations will not be enough.
I mean, they are getting cut here in terms of the price target is $16 from $24. The stock is trading below 16 already here. So, an outlook that things are not necessarily going to get that much worse from here, hence the hold rating and not a sell rating. But they say the stock will not regain its premium until the company can demonstrate its solutions are sustainably important to a growing number of customers.
By the way, Bloomberg noting since these folks reported earnings that was on February 27th, 13 analysts have cut price targets by an average of 13%. No analyst raised price targets.
All right, let's also talk about Deutsche Bank downgrading JetBlue Airways from buy to hold Frontier, also being cut as well. And the note citing an economic soft patch that will likely weigh on air travel demand here. The analyst here, Michael Lindenberg, leading this note and basically saying that the discount airlines are going to suffer more than the full price airlines here. So some of the other discount airlines were already on their hold list, and now JetBlue and Frontier are joining it.
Yeah, analysts saying JetBlue still faces uncertainty on a return to profitability, given they say that JetBlue is expecting a mid to high teens number of aircraft on the ground this year. Most on the street are actually at a hold at this point. In fact, how many buys are left on this name, Julie Hyman?
Tell me.
0.
Really?
0.
Wow. All right.
I don't know. Maybe a contrarian indicator. Who's to say?
Maybe.
I don't know.
Who's to say? Coming up, shares of Target sinking today as they warn of weak sales guidance. We're going to be joined by an analyst on the other side to discuss the best ways to be positioned within that retail sector. Stick around. Much more market domination still to come.
Target adding on to caution on the consumer as it becomes the latest retailer to warn about the potential impact of Trump tariffs. The retailer expecting profit pressure in its first quarter relative to the remainder of the year. Just last month, Walmart, remember, issued soft full-year guidance, pinning the blame on tariff uncertainty. So how should investors take in the retail landscape right now? Well, here to discuss is Roth Capital Partners Senior Research Analyst Bill Kirk. Bill, it is great to see you. So let's get right to this Target report here, Bill. So they forecast, it looks like, little to no sales growth this year. Stocks in the red. It's down about 20% now over the past 12 months. What do you make of the report and the reaction to results, Bill?
Sure. Let's start before the tariffs, right? So they just reported their 4Q. That's their holiday period, the most important period for this type of retailer. And profitability, holiday 2024, down 10% relative to holiday 2023. So profitability way worse in the key period. That's not a healthy starting position. And then on top of that, they went and said February was worse. So 4Q light, February has gotten worse, yet they're still guiding to the full year of 2025 being much better. But as you mentioned, what we now have on top of the starting point of not the healthiest is we have some of those tariff concerns. We have some of those consumer confidence concerns. So we don't really share the implied enthusiasm for an inflection in the business post February. We just don't see the confidence given what is happening now as kind of new variables.
Well, and Bill, a lot of the pressures that we're talking about are macro pressures, but I also have to wonder how much of all of this is Target specific as well, right? Is it only macro? Is it stuff that's going on with Target specifically? How are you sort of thinking about that?
It's a large portion macro. But that macro impacts different retailers in different ways based on what they sell. So Target has more discretionary type assortment, and take a regular grocery store like a Kroger, more staples, everyday necessity type assortment. So the assortment matters when you're looking at the macro exposure. Even if the macro exposure is impacting everyone, it probably impacts Target a bit more. On top of that, Target's closest competitor is Walmart. And Walmart is leaning into value offerings, right? Walmart is very much leaning into lower prices. Look at all the value we have. And that's the Walmart we've known for decades. But what Walmart's doing more and more that overlaps with Target is offering convenience. They're offering more delivery. They're offering wider delivery radius. And that overlaps with Target in a larger and larger way on that convenience variable that wasn't always available to Walmart, but now is today more so than ever.
Can I ask you, Bill, just kind of a broader question and get back to tariffs? Certainly, I mean, front and center today for investors. Are there retailers, Bill, that are more at tariff risk than others?
Absolutely. So it comes down to where you're sourcing your product from. Obviously, a kind of traditional grocery store is packaged food heavy that is sourced in the US, long lead time to make the final product, even if some ingredients might be sourced from other countries. So packaged food retailers are probably in the best spot. The discretionary assortment retailers that sell things from China are in a tricky spot. And even those that skew a bit heavier on produce sales. So produce, particularly outside of the summer months, comes from Mexico, or it's heavier from Mexico outside of the summer. And when that happens, if tariffs are on Mexican produce, the availability and the pricing of produce would be very likely to go up. So what you want to be in this environment is kind of, in some ways, one of the more boring retailers. You want to sell a lot of packaged food, a lot of center of the store items, because they're sourced locally, they're sourced domestically.
And Bill, to be clear, on things like produce or some of the discretionary items where prices are going to go up, do you expect these retailers to pass on all of the increases to their customers?
They're going to try to pass on the vast majority. When their entire basket is inflationary, if you go back just a couple years when food inflation was up double digits year over year, they passed that on, right? Their inputs were up double digits, and you and I saw it at the stores. It was up double digits for us. So we have scenarios where their entire store has been very inflationary for input costs, and they sent it right through. And part of the reason they can is we need this stuff, right? We're gonna buy this a little bit independent of price because we have to, right? Especially on the food side. And so I would expect them to try to pass the vast majority of it through.
In terms of ratings, Bill, I'm just looking, Target you're neutral on. Walmart, you still like. You got to buy. It's had a great run, Bill. I mean, it's up 60% over the past year. You say stick with that one.
I do. Stick with that one. What they are doing is part of the reason you see very few buys in the rest of my space. They are, as I kind of mentioned in the beginning, they're competing on convenience for the first time in decades. That's a generational change. For years, their convenience was a constant, right? They couldn't really offer anything more convenient than where their physical stores were. And COVID changed that. It sent a lot of shoppers online, and suddenly Walmart could deliver to folks who might have been unwilling to drive to the stores or maybe didn't even want to go into the stores. And so now Walmart is competing on another metric, probably the second most important metric in this type of retail, and that's convenience. And formerly, they could only compete on value. It's just how cheap could they be relative to peers? That was their proposition. Now it's how cheap can they be relative to peers and how convenient can they be relative to peers. So we think Walmart stands to gain share in this environment.
And Bill, I also want to ask you about Albertsons and Kroger's. Obviously, that deal not happening, some management shakeups for very different reasons at the two companies here. Albertsons a buy for you, Kroger's a neutral. Why are you where you are on those two?
Yeah, part of the Albertsons story, I think, that's misunderstood is the amount of kind of underlying asset value they have. They own a lot of really, really good real estate. Good real estate in grocery means very sticky customers, right? If you just have the best location, that is a huge advantage over some peers. And I think what you see now for Albertsons is they do some of the things operationally that Kroger had intended to do if they had owned them. And what I mean by that is Kroger was going to centralize Albertsons procurement. Right now, Albertsons buys separately by division, and there's a lot of savings that Albertsons can achieve by just centralizing procurement, buying bigger and in one kind of buying fashion to leverage power and scale over some of the manufacturers. So it's an underlying asset value story, and at the same time, here's a lot of cost savings opportunity as they move procurement into a more centralized fashion.
Bill, thanks for your time and those stock picks. Appreciate it.
Of course.
While we are wrapping up today's Market Domination, don't go anywhere. I've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.